Awesome. So we are here. It's hard to believe that we are kind of at the end of, or fast approaching the end of 2021. What a year for real estate. And we're here just to talk through it. We'll keep this brief and short. We won't have it more than 8 to 10 minutes. And Hayley's on board here to go through some slides with us. And we have our lender, our go-to lender, Jason Ossiton, who is at the Loan Depot and has been a tremendous resource through all of the ups and downs of what we've been seeing this year. So thank you, everybody. And what should we start? There's so much to talk about. What should we? Single families is kind of where we should start. Hayley, do you have some slides to show us?
Yeah, absolutely. So let's just go in and take a look here just to show everybody. Our orange line is San Francisco. Mm-hmm. And then our purple line is going to be Oakland and Berkeley. We're just going to look at those for right now, and Emeryville. And so if we're just looking at single families, this is over the last year. So this is the beginning of 2021. You can see January 2020. What year is it? And you can see where we started there. And then, oh, hi, COVID, boop. Okay, so there's COVID. And then we go through the year, and here's 2021. And we're currently looking at, this is the October numbers at the end here. So we're looking at single families right now. And this is the number of sold listings on a monthly basis. But let's just take a look at what everybody wants, which is the median sales price. So, if we look at year over year, the median sales price for San Francisco County for single family homes is up 12%. And if we look at Oakland and Berkeley, it's up 22%. Now, these are being pulled from all of our MLSs, our regional MLS. So that's where these numbers are coming from.
Yeah. And that speaks true to kind of our experience, because we help a lot of people who are maybe selling in San Francisco and moving to a single family in Oakland and or Berkeley. And some of those people, even some of our clients who were upgrading from condos in the East Bay, ended up buying in San Francisco because it's less crazy in San Francisco than it is. Now, there are pockets, which I think you'll probably show us, Hayley, because they tell quite a story. But, it's amazing that San Francisco presents itself almost as a better value in some regards.
Yeah, should we dive in and just look at District 2? You want to tell everybody what District 2 is, and I'll pull it up.
Well, the whole District 2, the one big winner in the new world of COVID are single family homes in quiet suburban style areas. Like if you, all the real estate around San Francisco, in Marin, in the East Bay, down the peninsula, has just, as you saw with the numbers in the East Bay, it's gone crazy because everybody wants a single family, a yard, detached space. Detachment, office space for home. They want it to be quiet. That walkability of being super central is not a number one factor, which was a huge driving factor. A lot of what we were used to for a decade just got flipped on its head. Yes. And so District 2 is the Sunset mostly in San Francisco, which is probably San Francisco's biggest single family home neighborhood. And I'll let you take it from here.
Yeah, I mean, if we're just looking at District 2 here, again, this is the sales price, the median sales price. May through July was kind of just like our really, really last big push I think we had just for us this year, and you can see, I mean, for a lot of people. But if you look at District 2, like the median sales price in July was 1.8 million. I remember when I started in real estate
in the Sunset in San Francisco, and look at the median sales price for San Francisco. It's like 400, 300, almost 400,000 lower.
Yeah, I remember when I started back in 2016, it was the land of the $1 million house. And I think that people still have that in their head. Like you can get $1 million house out there. You really can't. So it's just blown up. And, especially with like larger than average lots out there, gives people more space. I think that's just so highly desirable now. If we look at the percent sold over the list price, I think that's also really interesting. Like we saw, there was a dip here in January, a pretty significant one. And then this 6 months here was just absolutely crazy for everybody. And July was our peak. Things are starting to chill out a little bit, not hugely. I think that there's sort of a misconception that things are just going down and the market's cooling off. And I think we can kind of see here, like it remains to be seen the last couple of months of the year, but it's maybe flattening a bit. But
go back. I just want to show this statistic where hover over where we can see the percentages. District 2, 88.7% of listings are selling over the list price. And when we would get into a market in the past where, hey, a lot of stuff, it's all selling over, we'd be we'd be in the 50s to 60s. Like everything is selling over when your number is this high. It's so sorry, go ahead.
No, that's great. I think what another interesting, if we kind of just flip it on another angle here and we look at District 9. So do you want to tell people what District 9 is?
Yeah, so District 9 is basically the Mission, Bernal Heights, and actually goes into Soma. So you get a very strong neighborhood, Bernal Heights, for District 9, which has really been performing incredibly strongly. And then you get into the weaker side of the market, which is the condo in a very urban area with no outdoor space. And that's Soma.
Mm-hmm. Yeah. So it's interesting. It has Bernal, it has Soma, it's got Potrero, it's got Dogpatch, it's got the Mission, right?
Yeah.
So this is, obviously it does follow along with the city pretty closely. But if we were to just zoom in on Soma, and this is condominiums, by the way, I switched it to condominiums. But if we were to just sort of zoom in on Soma, that's pretty significant, that change there. For the pink line, that's Soma. So our if we look at days on market, that's pretty telling, right? That's our pink line is the average, median days on market. So from list to when it was sold. If you look at January, things were hanging on. That's where we saw that dip, right, in sales price, and our dip in most in percent sold over list. This corresponds, of course, with the days on market being higher, right? And then throughout the year, it did get stronger. Things were going quickly. And then we get into the summer and it started to creep up again. So again, the higher the number, the longer it sits on the market here.
Yeah. And
now
the lower.
we've got condos in October hanging on. Look at that. Average days on market is 116.
In comparison to San Francisco at 15. That is extraordinary. Can you go to the beginning of the year to see what the difference was between just the city and Soma? So they were 62 coming out of the end of last year and 87. So, that's a 30% difference. And now coming in at the end of this year, we're going into this. So that to us kind of says that this trend of the less urban kind of thing is getting stronger and not balancing out, which speaks to really, can we go in and start looking at inventories, Hayley? Because that's really where inventory has been a huge issue. And then Jason will talk to you about rates, because those are the two factors as we move forward that really are going to dictate what's going to happen.
So, all right. So this is sort of challenging, and also I think giving us a little bit of a, here we go. So active listings. We can look at new listings as well. But if we just look at active listings, you can kind of see, I mean, Soma, again, it's like kind of, we could probably take that out just to kind of zoom in.
Well, because it's taken so long and stuff's not moving, the inventory is just nobody's listing. And that's what happens in San Francisco. People white knuckle it. And, you know, that inventory, when the opportunity is better there, that inventory will increase in that area at a fairly rapid rate.
Yeah. And so, I mean, this is, you can take a look here, like you can see that this year has just been so tight on inventory, right? And it's September and then October going down. So this is seasonality of our market. We typically see things dip a little bit towards the end of the year inventory wise, but it's just been, I mean, with the number of buyers and inventory sort of remaining kind of steady here and not increasing, that's where we've just seen this super, super hot market for the most part.
And I think on that line there where you go for the year, that's like, it's a very consistent straight line, but on the other where we saw activity and the amount of volume and stuff happening, there were these huge rises. And that's because inventory just never changed. And the inventory was just flat, 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 and buyers were there. They didn't have any other choice but to beat each other out as best they could. So that's the one willing to pay the highest price rising to the top.
Yep.
So,
And there you can see the price, the average, sorry, the median sales price climbing up as well here.
Yeah.
The same.
So inventory is continuing to be our greatest challenge on our end. The other thing, rates, we gotta, like, how did rates go this year? And then what are the short-term kind of outlooks and any predictions long-term, Jason?
Yeah, well, obviously inventory has been an issue for a while now. It seems to be kind of near its worst levels. Besides supply driving home prices, interest rates also impact how much you can afford. We can all appreciate the mortgage industry has enjoyed extremely low rates for some time now. In the last month, however, rates have recently come off those historic lows. You know, there's a lot to do to inflation. So inflation is the arch enemy of bonds, which erodes the fixed rate of return. And bonds or mortgage-backed securities are what drive long-term mortgage rates. So inflation typically results in bonds being sold, which increases the rates. So a couple other driving forces in the shift are a strong stock market and a Federal Reserve policy changes. Just yesterday, due to inflation, the Fed announced they were going to begin tapering their asset purchasing. This bond buying stimulus launched early in the pandemic has helped keep rates low. So reducing their pricing is really buying.
Their purchase, is that where they're buying basically
pace? What's that?
They're buying debt. When they're buying bonds, they're buying
bonds. So that's contributed to higher rates when they're reducing that purchasing. But as a side note on that, the Fed is also reinvesting their balance sheet, which is going to help offset some of that bond selling and hopefully slow that increase in rates. So for those reasons, we do think rates will continue the slight upward trend in the at least immediate short term. You know, that being said, rates are still near historic lows. You can still find a sub 3% rate out there, which is amazing.
On a 30-year fixed?
On a 30-year fixed, yeah.
Wow.
Yeah,
okay.
So, you know, every scenario is a little different for every person. But for the long-term outlook, it's always tough to predict those crystal ball predictions. However, the safe bet, of course, is that this upward trend will continue, although likely at a slow pace. Some experts believe that rates will be as high as 0.5 to a full % higher this time next year. So as prices and rates rise, you know, the cost of buying moves up as well, right?
Yeah.
That's important to point out, right? For somebody who like doesn't really understand the mortgage process or what that all means. It's important for people to remember that, oh, you know, you could think I'm just going to wait for the market to cool off, for prices to come down or level off. And as rates go up, affordability changes, right? So it's not like, oh, if the price drops, I'm going to be able to buy the house of my dreams here. if the rate's going up, your affordability is changing, right? So
Yeah.
Eddie, is it 10% that the market would have to dip in pricing on average pricing to equal 1% of an interest rate
Yep,
change?
that's about right. Yeah.
Yeah. A 1% increase on the interest rate of the mortgage of the money you're borrowing is exactly the same as if the price of the property went up by 10%. So what happens is that the rates will creep up and prices will come down, but they don't come down. It'll come down a 4, 5, 6%. So you're not meeting it in an equal spot. So you can the seller will get less money for their property, but the buyer will end up paying more. So
so it would behoove all of our people watching, if they're curious what this really means, to get a mortgage calculator on their phone. Just get the app, Eddie app. Carl's Mortgage is what we use, and just plug in, like, Jason was saying, a 3% rate, just to use for right now, and then change that and keep the price of the home the same, and change that 1/4 of a point, 1/2 a point, and see how that changes the monthly payment. It's really important to take a look at that.
Yeah. So see, ultimately, as we move forward, I think generally everybody feels that, especially with the way things kind of look on the trend that we've experienced, I don't think we're going to have any change in that trend, in the sense that if you're in the single family home market, it will still be challenging. Inventory will, I think, with the results that people will see from this year that have passed, it should bump up the amount of people who want to make a change and sell the inventory that they're on. We're also hoping for Prop 19 to kick in, where that's changing. People who are inheriting property are now not able to stay on that original property tax cheap bill. They're getting reassessed up to current value, and that can encourage a lot of people to turn around and sell. So I think there is some wind coming in the sales for inventory as we move into the new year. So if we can keep inventory kind of rising a bit, then I think we can, pricing, while it's probably not going to go down a lot, will probably stay pretty stable. So Jason, if anybody's looking for more advice or they want to find you, how can they find you?
You can call me at 415-524-8695.
Perfect. And online,
my email address is jbo@loandepot.com, and feel free to reach out anytime. Happy to talk to anyone.
Perfect. And for us, Hayley, where do people find us?
Yep, elevationrealestate.com. If you go to our blog there, you can find a lot of really fun resources that we have, different webinars that we've done on different subjects that are evergreen, so applicable anytime. And you can find us on Facebook and Instagram at Elevation SF, or just call us, email us. We're everywhere.
I love it. All right. Happy holidays. Happy holidays. As we move in, it's November. It's the holiday time. Bye.
Here.